Hello and welcome to the next of our lecture recaps. This is a recap of our introductory lecture on financial instruments, on how to classify those financial instruments. So remember, you can download this lecture as a PDF or any of our mind maps as a PDF from the website shown for free, or you can purchase the full course on which this recap is based should you wish to do so. So remember, the first thing we looked at was what is a financial instrument, and we don't want to make this too complicated. We want to keep it simple. Financial instrument is, remember, defined as a contract that gives rise to a financial asset in one entity and a financial liability in another entity. But we keep it simple and we think, well, if we want to raise some capital as a business, well, we could issue some bonds to raise that capital. That would be a liability to us because we'd need to pay interest on the bonds and then we'd need to pay that money back at some stage. So that's a financial liability to us as an entity. If someone takes up those bonds and gives us the capital, well, they will have received the money each year, the interest. They will get the interest each year and it will be an asset to them because at the end, that capital will be paid back to them. So that would be a financial asset in that entity. So that's a very simple example of a financial instrument. So try to think back to that whenever you're thinking of what this is. So IAS 32 outlines that classification. Remember, a financial asset could be cash, it could be the equity of another entity, i.e. the shares of another entity, or it could be a contract to receive cash or a financial asset. So it could even be a receivable. That would be a contract to receive cash. That's a financial asset. Also, it could be a contract to exchange financial instruments under potentially favourable conditions. A financial liability, well, that could be a contract to deliver cash, or it could be a contract to exchange financial instruments under potentially unfavourable conditions. An equity instrument, remember, is something that is not for cash or another asset, but is settled in shares. So equity means shares, really. So remember, we need to say, well, for each of these financial assets or liabilities, how do we classify them? And that will then tell us how we can treat them. So what we'll do is we'll use IAS 32 first of all to identify what we have. So they will tell us that we classify these financial assets and liabilities when we recognise them, not when we settle them. So as soon as we are party to them, we need to recognise and classify them. So the types we've already mentioned: financial assets, financial liabilities, and also in there will be interest, dividends, losses and gains. So our classification will come under IAS 39. So this is the recognition and measurement, and it says that our initial measurement will be at fair value. So initial measurement for financial assets in particular we'll think about here will be at fair value. If there are any transaction costs, we'll add them to the asset and subtract them from a liability, unless they're held at what's called fair value through profit and loss, in which case they'd be expensed. So we looked at that in illustration 1. So transaction costs are added to an asset, subtracted from a liability, unless they are going to be held at fair value through profit and loss. So if we measure our financial assets, for example, initially at fair value, where do we get that from? Well, it might be the quoted market price. If there's no active market for it, we might need to make a reliable measure. If there's no reliable measure available, we'd just have it at cost less any impairments. So that's how we'd get the initial measurement, the fair value that we'd recognise it at. Subsequent measurement, well, for an asset, we can measure it at one of 4 things that we'll look at here. A fair value through profit and loss, held to maturity, loans and receivables, or available for sale. So there'll be a different treatment for each of those, and we'll look at those now. A liability, well, those are financial liabilities, and they will be at fair value through profit and loss or amortised cost, which we will look at as well. So financial assets, first of all, remember the 4 classifications. First of all, fair value through profit and loss. Items that are held for trading purposes, i.e. short-term items like derivatives, will be held at fair value through profit and loss. So what you'll need to do in an exam question is look at why the entity is holding each of its items, and that will determine how you'll classify it. So if you're told it's held for trading purposes, well then that will be at fair value through profit and loss. That means it's revalued to fair value at each year end, and the gain or loss is taken to the income statement. So that's the treatment for fair value through profit and loss. For items that held to maturity, these will be debt that will be held until maturity, i.e. debt held until you get it back. So there will be fixed payments and a maturity date on it, and these will be quoted on an active market. So these would be things like the debentures of another entity, the debentures of big companies. And these will be measured at amortised cost. Loans and receivables are very similar to held to maturity, except they're not for quoted debentures. So these are fixed payments and maturity, but they're not quoted. And again, these will be measured at amortised cost. The only difference with those is that they're classified differently. The treatment is exactly the same. Available for sale then is anything that's not in the other categories. Don't mix this up with fair value through profit and loss. Things that are actually held for trading purposes that you do intend to sell, ironically, aren't held as available for sale. They're held as fair value through profit and loss. So anything not in the other categories will be available for sale. It can't be held for trading because that would need to be fair value through profit and loss. So these would be things like shares in other companies that you're not holding at fair value through profit and loss. The measurement for these is that we'll measure them at fair value plus costs. We'll remeasure them at the reporting date, and the gains or losses will go to reserves, not the income statement. So remeasure to fair value at each year end with the gain or loss to reserves. When we then sell that item, we'll take the cumulative gains or losses that we have in reserves and we'll take it all through the income statement. So effectively we're showing that gain or loss twice. We show it through comprehensive income when we take it to reserves, and we take it through the actual income statement whenever we sell it. So we looked at that in detail in illustration 2. When we talked lastly about financial liabilities, we said that there was 2 items we could do: fair value through profit and loss if it's held for trading purposes, like short-term derivatives. And again, that's where we revalue to fair value each year, and the gain or loss goes to the income statement. So that's the same as a financial asset. Anything else will be held at amortised cost. So that will be things like bank loans. So anything that's not fair value through profit and loss, like a bank loan, will be held at amortised cost. So that was a recap of our lecture on financial instruments classification.